It's noon here in Ventnor City, New Jersey, and our nation's capital, Washington, D.C. Or is that Torrey Pines? I'm not 100% certain, but this is CarEdge Live for Wednesday, October 1st, with your hosts, me, Ray, here in Ventnor City, and Zach. Well, contemplating maybe a round of golf or something. How are you today, handsome?
I am doing okay, Pops. How are you doing this morning? Excited to be here with you and our community to talk a little bit about what's going on at Wells Fargo and Edmunds. We're not even going to do the promo. We're just going to jump right into it. Dad, Wells Fargo, they are doing something a little bit on the crazy side, at least as far as we're concerned, pulled up right there on the screen from Car Dealership Guy. Dad, let me read this out, and then we need your take. And then we're going to talk about the Edmunds data that is also pretty doggone scary. Wells Fargo is pushing deeper into riskier auto loans. An internal memo obtained by CDG News shows the bank's dealer pilot program will now approve borrowers with FICO greater or equal to 540 at up to 150% loan to value ratio. We're actually going to pause right there. Can you please explain to me why that one line in this tweet gives me the confidence to say Wells Fargo just rang the auto industry alarm bell?
Sure. If you have a credit score that's equal to or slightly better than 540, which, ladies and gentlemen, is subprime territory, there is no way in hell you should be getting an automobile loan of up to 150% of the loan to value ratio of that vehicle. Now, what is loan to value ratio? Let's say the vehicle has a value of $10,000. Well, the bank would finance up to $15,000 on that $10,000 valued vehicle, meaning that, well, $5,000 worth of the $15,000 loan is secured by nothing but the air that we breathe. Okay, so why could that possibly be risky when you're willing to do that for people who have shown a propensity in the past to not handle their credit obligations in a timely manner?
And we know Wells Fargo, Dad, their originations have been surging. This is the data that we have from their most recent quarterly earnings. Wells Fargo Auto's originations have increased 87% year over year. So this begs the question, Pops.
Yes.
Why is Wells Fargo here? I'll pull it up from Orange Rubber Ducky. Interesting. Why would a business want to get into riskier things? What's driving this? It's also coming on the heels of, we talked about Ford earlier in the week doing more subprime lending. Like, why are we seeing more of these companies get into riskier and riskier things here? Just to flash it, Ford lowers F-150 rates for subprime buyers. Like, all of this is about getting more subprime customers. Why are they doing this?
To give the appearance that they will end up being more profitable, when in all likelihood it will have the opposite outcome. Yes, you can say we've increased our loans by 87% year over year. In order to do that, we had to give loans of up to 150% of the loan to value ratio on a vehicle to people who normally would not qualify. Well, that's just, what's the phrase? Kicking the can down the road. That's just pretending that you're entering into a contract that should have a profitable conclusion when you know more than likely it will not.
Do you agree with this comment? 2008 2.0, let's go. 150%, by the way, loan to value ratio is absolutely nuts, regardless of your credit history, to your point earlier with the example. So do you think this is 2008 2.0, but for the auto industry this time? Obviously not the housing side.
It certainly seems like it. And if there is a collapse in the automotive finance market, it is significantly different than when we had that collapse in the mortgage market. The reason for that is mortgages, I believe, account for like $13.2 trillion, something like that. And auto loans account for like $2 trillion. So even though trillions sound like a lot, and I'm pretty sure they are, especially when, well, like I'm I'm proud to admit I'm a thousandaire. So trillions are a lot, but it is. I shouldn't say, but it's small potatoes. 2 trillion is small potatoes in comparison to 13 trillion. So if there is a collapse in automotive finance, it won't have as large an impact on the overall financial markets as the mortgage collapse did.
Sure. The magnitudes of scale here are different. Maybe 6 times greater is the mortgage debt component than the auto. But the principles of what's happening,
Yes.
Dad, feel eerily similar from 2008 to right now. Again, the big story this morning, Wells Fargo coming out, a new internal memo has been obtained and shared. If you have a FICO auto score greater than 540, you can get approved for an auto loan at 150% loan to value. Now, if you're at the 500 to 539 range, you can only get up to 110% LTV. That's also crazy, Dad. That's also crazy. That means, 500 to 539 FICO score means you have demonstrated consistently an inability to make good on your credit obligations. A 100+% loan to value ratio means you are driving off the lot in negative equity. You are not putting a down payment down enough. You are bringing negative equity already to the table. Like, that is scary, very scary, which is the same thing. You've always said it. If you could fog a mirror back in 08, you could get approved for a mortgage. Principles wise, magnitudes of scale different, but principles wise, this is the same thing happening all over again. Ford in the news for it recently. Carvana's been in the news for it as well. And now we have Wells Fargo, yet another, and we haven't even talked about the Edmunds data yet, but yet another example of the auto market credit chaos.
Let's talk about credit, okay? And how credit has normally been thought of by the lenders. Okay, there's basically 3 parts. There's ability, stability, and willingness. So what do I mean by that? Ability. Does one have the ability, based on income and other factors, to be able to pay back the loan? Okay, so do you earn enough money, whether it be through investments or through your job, but do you actually have the ability to pay back the loan? Stability. Well, what are they looking for when they're looking for stability? Well, how long have you been working in the field in which you are employed? How long have you been at your current employer? Are you a job hopper? Have you been at your current employer for 10 years? In all likelihood, that you will continue to be there. That's stability. How long have you lived at your current address? Things of that nature. And then willingness. What do they mean when they say willingness? Well, the willingness is, how have you handled your previous credit obligations? Have you handled them in a timely manner? Have you handled them well enough to qualify for future credit? Now, in my day, in the auto industry, on the retail side of things, if you had less than stellar credit, and trust me, anything from 500 and up to 540 or anything below 600 was not considered stellar credit. Even the subprime lenders would look at a customer like that and say, we will finance 80% of the loan to value ratio, 90%. Whatever it was, they wanted to see participation from the customer. What do I mean by participation? Cash or trade equity down. They wanted to see that the customer had an investment in this so that it would encourage them to make the payments.
Some skin in the game, yeah.
Yes, and so if you're going to take somebody whose credit score is between 500 and 539 and say, yeah, we're willing to advance we're willing to advance it 10% above the value of the vehicle, that's not skin in the game. That's not enough participation. So that you basically know that as a lender, when you're doing this, you are setting these customers up to fail. You know it's going to happen, but you also know in the short term, It is going to improve the look of your balance sheet until, I don't know, a year from now, 2 years from now, when we look back at your 2025 portfolio and it's not performing at the level that you thought it should or your investors thought it should.
Dad, all you got to do is a quick Google search of auto loan delinquencies. The first article right here from Reuters: U.S. auto bankruptcies show rising credit pain in low income households. We have the highest rate of auto loan delinquencies right now that we have ever had in the United States of America, and it is most pronounced amongst those with subprime credit. And at the same exact time, again, I'm just going to run back through it, the recent stories from the past week or two: Ford lowers F-150 interest rates for subprime buyers to boost sales, Wall Street Journal reports. An internal memo obtained by CDG News shows the bank, this being Wells Fargo, piloting a dealer program that will now approve borrowers with a FICO of 540 or greater at up to 150% of loan-to-value ratio, and borrowers with a FICO of 500 to 539 at up to 110% loan-to-value ratio. In the same breath, Edmunds, Dad, just put out the latest data on what's the state of the auto finance market. And I want to share this information with you here because it really puts a bow on all of this. New car buyers are stretching further than ever to make their monthly payments work. This, again, is some commentary from CDG. In Q3, the average new car down payment fell to $6,020, the lowest level in nearly 4 years. The average amount financed went up to $42,647. 20% of buyers are taking on $1,000 a month or more payments, and 22% of auto loans now stretch for 7 years or longer. This is like, we haven't even gone into the loan loss provisions data that CarMax just most recently put out, which was a massive increase in the amount of money that they're setting aside for auto loans they wrote that they don't think are going to come good. We've got the information from Carvana. You make $100 a week, they'll approve you for an auto loan. What type of despair could that spell for the auto industry and for consumers? Like, you do not have to be that bright of a bulb to see how messy the current affordability crisis is, and then the depths that these finance companies are going to ultimately keep the merry-go-round going around, ring, swing by swing by swing.
I don't think the bulb has to light at all for you to realize that this isn't something that's sustainable. It is indentured slavery to a degree to these poor people that have not handled their credit well in the past, to subject them to the unreasonable amount of loan to value.
You've used the word before. It's enablement, Dad. It's the banks are enablers.
They're complicit.
They're complicit. Yeah.
Okay. They are complicit in this indentured slavery where they're
financial slavery, Dad.
Financial slavery. Okay. Where they are taking these people that don't know how or have not shown a propensity to understand credit in the past and bury them deeper and deeper into debt in such a way that they will never, ever, ever get out of it. And so banks are complicit in this, in not only encouraging it to happen, but gleefully participating in making it happen. The dealerships, they're ecstatic about it because it's like, well, we didn't know how we were ever going to get these people financed, but hey, Wells Fargo came to the rescue. It is, we are artificially moving metal to prop up an economy that is probably in more desperate shape than we would like to ever admit.
Yeah.
Okay. And this can't go on forever. It just cannot.
Even if you take the broader economy out of it, Dad, the signs just within auto are insanely damning. You have prices of vehicles through the roof. We are starting to finally see a little bit, which I think is influencing why we're seeing these manufacturers, captive finance companies, and independent financing companies like Wells Fargo start to do this more aggressive lending, is we actually are starting to finally see some pullback from consumers, because for a long time there'd still been demand at high prices, but we've seen prices go sky high. finally sales are slowing down. Inventory is starting to build up. I flashed that data yesterday. Used car inventory is up year over year. New car inventory is up year over year. So there's more cars and there's not enough customers. How do you get more customers? You start approving more reckless auto loans.
And this is cyclical, because Wells Fargo had been considered somewhat of a secondary lender for automotive for years, and it cost them a ton of money, and they basically got out of it for a while, where they said, okay, we're going to concentrate on people with good credit, and apparently, well, it's not apparently. If you don't learn from history, you're bound to repeat it. So you're not learning from history that when you go down this path, that financially it doesn't necessarily make the best sense for either the bank or the borrower. And so even though they took a couple years off from secondary and subprime lending, they've jumped back into the pool with both feet.
Yeah.
Well, is the outcome going to be any different this time around? I don't think so. I don't see how it would be. But will it spruce up the balance sheet for the short term? My guess is it will.
Yeah, it'll make the numbers look good in the short term. That's what we've seen a bunch of these organizations do in service of trying to hit some sort of stock performance goal, try and get a bonus, things like that. But to your point, Dad, I actually think the onus is on customers more than ever before. Just because you can get approved by Wells Fargo for 150% loan to value ratio and you have a, 550 credit score does not mean you take that auto loan. You used to use the line in your career. Well, the bank, or maybe, I don't know if you use it, but you've shared the line with me. Well, the bank approved you for this much. So you can, that's BS. Just because you can get approved for it doesn't mean you should take on that financial burden.
Well, exactly. And yes, that line gets thrown around a lot to customers. Well, you don't think the bank would have approved you for a loan this size if they didn't think you had the ability to be making the payments, even though in the back of your head as the customer, you're going, how the hell am I going to do this? And then I will also suggest to you that in many, many, many cases, these borrowers are going to be saddled with back-end products from the finance office.
Extended warranty, paint
extended
protection.
warranties, dent and digging repair, whatever it is, because the finance people are going to look at them and go, the bank would really appreciate it if you had all these coverage so that there will never be an issue if you have a problem down the road. And so that's what's about to happen. And so the back end profits on these deals are going to be astronomical. Just crazy stuff.
It is a little bit of a recipe for disaster. At least I like to think it is. But Dad, let's turn our attention to some other news, this time coming from Hyundai. Did you see the price cuts that they announced on the Ioniq 5? Did you see this?
I did not.
You're about to be. I'm so excited to get your live reaction. Here we go, Dad. Hyundai Motor Company will reduce the sticker price of its Hyundai Ioniq 5 compact crossover by as much as $9,800 across trims for the 2026 model year, while continuing to offer a $7,500 cash incentive on 2025 models through October. So for those of you that are not familiar, EV tax credits, well, they just ended. Now, there's a bit of a loophole that we discussed yesterday that Ford and GM are trying to take advantage of. But Dad, there you go. Up to a $10,000, I'm rounding up, $9,800 to $10,000 price decrease year over year for the 25 to 26 model years, and Hyundai continuing to offer a $7,500 cash incentive on the 2025s. Wowza.
Well, what's really interesting about that, just at first blush, that just indicates to me just how overpriced all these vehicles have been. And the reason they were as overpriced as they were is because that they knew that there were enough federal and state incentives to make them more attractive to customers. And that when those incentives go away, well, then suddenly the manufacturer has the capability of reducing the value of the vehicle that they're asking for it. because they know it's the only way they'll be able to sell it. But
Yeah,
it's
this makes no sense because all these automakers have come out and said we don't make any money on EVs.
I get it.
Yet
Yeah.
on a whim, you can reduce your price by $9,800. Come on, man. You can extend the 70. Like, sure, they're publicly traded companies. You see their quarterly earnings. They don't make a lot of money, I guess, but from a percentage standpoint, but this is BS, man. You can just wake up and reduce the price by 10 G's. Come on, get out of here.
Yeah. So maybe in hindsight, maybe the government should have never been offering any type of tax incentives, income tax incentives and credits in order to help move these vehicles, because all you did by doing that is make sure that the manufacturers were making their hefty profits, because the federal governments and state governments were underwriting the sales of these things.
Dad, and it worked. I mean, let's be very clear here. The tax credits worked. You can see right here, EV sales for Hyundai last month were up 153%. So they sold a ton of these. And who's underwriting that? Partially the federal government.
No, you and I, and every other American, and every
yeah,
other taxpayer out there.
Yeah, which is us. Yeah.
Yes. So when we say, well, the federal government doesn't operate without our money. Okay, it's pretty damn simple. Okay, so it's us. So when the federal government subsidizes the sale of EVs, it's you, me, and every other American taxpayer that is subsidizing the sale of those EVs. And as it turns out, apparently the manufacturers could have afforded to just lower the damn prices of those vehicles to sell them without any type of incentivization from the government, from you and I. But, bless them, they're smart enough to get the governments to contribute so that they can maintain their profit margins. And meanwhile, we just continue to build our deficits. Okay, perfect.
GM, Dad, their EV sales were up 107% for the month, which is absolutely crazy. Toyota sold more cars last month. Lexus sold more cars last month. So a really, really, really strong month for the auto industry. We're starting to get the data here that shows that a lot of EV sales, obviously, but even Toyota and Lexus, they just had insanely strong months, 14% growth. That's incredible.
Well, we expected it. We expected the end of the federal tax credits to spur and pull forward EV sales. It worked. It did what it was supposed to do. Had they left it alone and said that they were going to expire December 31st instead of September 30th, then we wouldn't have seen such a strong EV sales growth in September. We would have seen it in November and December.
Yeah.
People pulled forward. They pulled so many customers forward to take advantage of that. If the sales hadn't gone up, then something was definitely wrong with the entire situation.
Yeah, absolutely. Yeah. All right. So we've got the poll heads. That's what just happened in the most recent month. Now, the news of today is obviously we've got more and more aggressive lending options to try and get more people approved for auto loans to buy cars. Makes me wonder, Dad, just quite how desperate this industry is going to look as we head into the end of the year. This is where these automakers are trying to sell as many cars as possible. And obviously, Wells Fargo is an example. They're trying to be as aggressive as possible to approve more and more auto loans. That's how you keep the lights on in this thing. You either create a false sense of urgency, or in the case of EVs, it was a real sense of urgency.
Yes.
Although now it feels a little bit false if you bought one of those Ioniq 5s because, well, the prices for the 2026 model year just went down by 10 grand. False sense of urgency, I think, is actually more appropriate. And then you've got the approvals, getting more and more approvals, and customers having to bring fewer dollars down to the table to make it happen. This is a messy situation, and a great reminder to our community, you don't need to buy a car. Don't buy one. Just keep driving the thing you have into the ground.
Yeah, it is. It is. If you can't make the cars more affordable for the vast majority of people, well, then make the getting a loan easier for those who shouldn't qualify, and then you can bring them into the pool of customers. And so that's what we're doing. And when it's the collective we of the industry, banking and automotive, not me and you, but that's what they're doing. And we just know that down the road, this will not end well. Just saying.
October 1st, 2025. This will not end well. You heard it here first.
Well, yes, you did. That's my prediction. This will not end well, ladies and gentlemen.
Dad, 2 comments really quick, and then we'll call it a show. From Rich, acts of desperation in the auto market are growing. I agree. I actually think that the cadence at which we're hearing these, stories, seeing these stories, I think it is increasing, and I do think it is more important than ever before to stay on top of the news of what's going on, because it does create opportunities. And from Joe earlier in the show, thanks for the contribution, Joe, wishing us a happy new year and asking us about Yom Kippur. I'm not fasting. I don't know. Is today Yom Kippur?
Well, I can afford to fast. When is Yom Kippur? Should be any day now. If it's Friday, we're taking the day off.
I'm traveling. You can maybe do a show. I don't know. We can talk about it, but I'm traveling on Friday, so I won't be able to do the show. But
I have a media obligation at 12.
Oh yeah, you're doing another interview. Yeah. So, but anyway, we appreciate the kind wishes and the thoughtful contribution. Dad, let's call it a show for today. We're back tomorrow though, so tune in. I'm sure we'll have more news for CarEdge Live and things to talk about. I like your yellow shirt. You look vibrant today, Pops.
Well, I'm trying to be as vibrant as I can. Yes.
I love it.
Yes,
you look good.
Too. Thank you.
All right, folks. We're back tomorrow. I love you, Dad.
Yep. Love you too, handsome.